Hi students, welcome back to our classes. So we are discussing about the standard costing and today we are in class number 26 and today we are going to discuss about the overhead variance. So in today's class I will cover both fixed overhead variance and variable overhead variance, and both of these are part of the overhead variance. Okay, so please watch all the two classes taken before this, which covers the material variances and labor variances. Okay, so let's go inside the overhead variance for the day. So apart from this, there are two more variances. This is sales variance and profit variance, which will be covered in the upcoming class in the May month. Okay, so moving to the next slide. Yes, so fixed overhead variance, as you can see here. So we have seen the material variances, why our actual cost, which is reported in the P&L after doing the month closing. So every month, as a finance people, you will be doing the month end closure, in which you will pass all the entries, book all the bills, and final month closing figure will be the month closing P&L and month closing balance sheet generation. That is called the month closing activities. And after the month closing activities, the finance metrics is achieved. But how the organizational metrics will be achieved? That will be achieved when the management, you show the information to management that, sir, this is what is the budget you have approved, to the board of directors or to the managing director or to the head of the business. You will report that this is what is the budget approved and this is what is the actual and this is what is the variance. Okay, and that variance you are bifurcating into various heads. Why? We have to fix the responsibility. For example, material cost variance. Okay, it is bifurcated into material price variance. Okay, so if any material cost variance due to price, the question will be put to the purchase department. So they are negotiating with the vendor and the price is settled by them. So why I am saying this, or why I am repeating this, is the main objective of variance is to understand why the actual is different from the budget and who is responsible for that, fixing the responsibility. So finance has to give the data to management in such a fashion, these are all the issues happened and these are all the analysis of the issue and this is all the responsible person for the issue. So we will report that, and the questions will be asked by the top management to the responsible person. So responsible person need to prepare a report against all the adverse or favorable variances that has happened. Okay, so this is what is called a variance analysis, and that's why this is very important. Okay, if you have completed your CMA and going inside a factory and you are placed inside the costing department, for sure you will be doing this activity. Or if you are in different role like product costing or cost audit kind of role also, during job rotation you will anyway touch this, and this standard cost is for sure going to be your profile. So this is very important. I also suggest you to know a lot of details about standard costing in a practical scenario, which will help you to fetch a costing department job. Okay, so let's go inside today's discussion. So fixed overhead variance, I have seen many students getting confused in the fixed overhead variance, but it is actually very easy. So what I did is, why should I go explaining what is the formula mentioned in the book? So I derived a different formula, or I mean to say, the same formula I have plotted in a different way, so that it will be easy for you to understand. The second thing is easy for you to even memorize or easy for you to replicate in the examination. So considering that you have to deliver or score good marks, okay, you can just check the matrix I have prepared so that you cannot go wrong. So as I said earlier, we cannot go wrong in standard costing itself, because there is a check after the answers of that, whether the answer is correct or not, we can check also. Okay, so a simple mathematic calculation we can check. Okay, so any major issue may happen, but if only the minor issue you are showing, that we are having a checkpoint which we already discussed in our material variances, labor variances. Okay, so now let's go inside the fixed overhead variance. So fixed overhead variances, what is fixed overhead? Fixed overheads or fixed cost of the company, and this cost of the company is budgeted while doing the budgeting process. For the next financial year we have created the budget and the actual is little different, and because of which a variance is arrived. What are the examples of fixed overheads? One of the variance you can say is the rent of a company. A company is having a factory, rented factory, so they have to pay a rent whether you are producing or not producing, whether the shop is running or not, you have to pay for it. So it is called a fixed cost. So it is a period based cost. Okay, so it is not there, it is not it is not derived out of production or nothing. So anyway you are going to render that cost. Okay, that is called fixed cost. So now in the fixed overhead variance problem, there are two types of problem. Problem number one, in which the budgeted working days and actual working days are same, or there is no detail about working days given. Okay, so that is called, I mentioned as type 1. So what is type 1? Actual working days is same as budgeted working days. Okay, so in the question they will give the actual scenario and the budgeted scenario, in which the actual working days and budgeted working days are same, or they have not given detail about the working days itself, which means we have to assume it as same. So if the working days are same, okay, if the working days are same, then we have to approach the problem using type 1. So what is type 1? Here I have given the type 1. So from the question we have to find the budgeted hours, actual hours and standard hours. I'm giving a tag for it so that I can create a formula. I'm calling budgeted hours as A, actual hours as B, and standard hours as C. So what is budgeted hours? Budgeted hour is the number of hours, uh, it is as per the budget. So as per the budget, the shop will run for how much hours? That is the budgeted hours. Actually, the shop has run, whether it is the machine hour or a man hour. Sorry. So how much is the actual hours the shop has run? That is the actual hour. So what is the standard hour? Standard hour is the for producing the actual production unit, actual quantity you have produced. For that, what should be the standard hour? So what should be the standard hour? For producing the actual quantity, you have incurred actual hour, but as per standard, what should have been the hour? And that is called standard hour. So now you know budgeted hour, that is budget. Okay, actual hour is actually what is incurred, but standard hour for actual quantity or activity that has happened as per budget or as per standard, what should have been the hour? That is the standard hour. So there is a minor difference between the standard hour and budget hour, which you should understand. Okay, so next is the rate. So what is the rate? Okay, rate is all the overheads will be absorbed at a particular rate. Okay, and we call it as a recovery rate. Why we in the practical scenario in the factory we call it as a recovery rate? Because number of units is produced and number of units is sold. Okay, and in the costing of the particular product, fixed overheads recovery will also be sitting. So if you sell a product, it will pay for the material, it will pay for the labor, it will pay for the variable overheads, and as well as it will pay for the fixed cost also. Even if it is marginal costing, through contribution it is going to pay for the fixed cost. Okay, so anyway our product cost will be determined with the help of fixed cost also, because it is a cost, we have to take the cost to make the company profitable. So we can call that is called the recovery rate. Okay, so the rate at which this is recovered. So okay, this rate is per hour rate, and I am calling this rate as D, and this rate is same for the budget hours and standard hours. Standard rate will be given by the production department during the budgeting process. So the budget will be created with the help of standard rate only. So standard rate is same for the standard hours also, and also for the budgeted hours also. Okay. And in the question directly the actual fixed overheads will be given in the question. Most probably budgeted fixed overheads will also be given in the question, or else no issue. Budgeted hours multiplied by standard rate will give you, so A multiplied by D will give you E, and C multiplied by D will give you G. Okay, so what is our aim? Any question in which working days are not given, or actual working days and budgeted working days are same, in that case you will use this matrix. As per this matrix you will put the hours, budget hours, actual hours, standard hours. Next, against budget hours, what is the standard rate? Against standard hours, what is the standard rate? Both are same. Okay, that's why I call D in both the places. Okay, next, the product of hours and rate will give the overheads. So budgeted fixed overheads, actual fixed overheads, it will be given in the question itself, and standard fixed overheads. So I have given A, B, C, D, E, F and G. Now I have given the formula for here. What is fixed overhead cost variance? Fixed overhead cost variance. Cost variance is the major variance. It is the head or the sum total of all the other variances. It is G minus F. So what is the standard fixed overheads minus actual fixed overhead will be the G minus F will be the fixed overhead cost variance. So what is the expenditure variance? Expenditure variance is E minus F. E minus F. So as per budget, what is the expenditure, and as per actual, what is the expenditure? That is called expenditure variance. So as per budget, you would have budgeted fixed overhead has to be 10,000. Actual will be 12,000. So 10,000 minus 12,000 is equal to minus 2,000, which means 2,000 adverse variance. Okay. So that is expenditure variance. It is very simple. Okay. So the first variance is between G and F. The next variance is between F and E, which is the cost variance we have completed, and expenditure variance we have completed. Next is the volume variance between the budgeted fixed overhead and standard fixed overhead, which is G minus E. Why? Because standard fixed overheads is derived from standard hours, which is for the actual production. For actual production, as per standard rate, what is the standard hours? So since it is derived out of actual hours, we have to do the volume variance. So volume wise, the budget minus standard, budgeted fixed overheads minus, standard fixed overheads minus budgeted fixed overheads will give you the volume variance. So the first variance, cost variance is between G and F, and the second variance, expenditure variance, is between E and F, and the third variance, which is the volume variance, is between G and E. Okay, so we have completed three variants. Next is the efficiency variance. So what is efficiency? How efficient you are doing a work. Okay, so it is between the hours. If you see C minus B, standard hours minus actual hours. So actual hours, you have done the job in a particular hour. Standard is something different. So standard minus actual, how efficient are you, multiplied by the standard rate D will give you the efficiency variance. So efficiency variance is between C and B. And what is the capacity variance? So capacity variance is between B and A. What is the actual and what is the budget? As per budget, what is the capacity, that we all know as a finance people, and actual, this much is the capacity. Because of the capacity, because of the hours difference, this is the capacity level variance. So this is between B and A is the capacity variance. Okay, so this is the matrix. From this matrix we can, I have derived all this formula. You can just note down in the notebook. Once you note down this, it becomes as simple as that. Now we will see one problem of this type. Okay, so it is illustration number 10. So budgeted hours is given. Okay, and budgeted hours 180 is given. So budgeted hours we have taken 180 here. Next is standard rate of article produced per hour. So per hour, this is standard rate. So this is not the rate you have to take. This is the rate of article production per hour. In 1 hour, you can produce 50 units. Okay, that is the standard. Okay, budgeted fixed overheads is given 2700, and budgeted fixed overheads here it is taken as 2700. So the same matrix which we discussed now, I am just filling that template. Actual production quantity is given, actual hours is given 175. So actual hours 175, I have taken it here. Next is actual fixed overheads is also given, actual fixed overheads 2800, I have taken it here. So most of the matrix is ready, but I think few more data is required. The first data that is required is standard hour. What is the standard hour? Standard hour is nothing but number of hours required for actual production. So what is the actual production here? We have produced 9,200 units. Superb. Okay, and 9,200 units, and in 1 hour we can produce 50 units. So which means how much hour is the standard? 9,200 divided by 50 is going to be 184 is the standard hours. So we have found budget hours is given in the question, actual hours is given in the question, standard hours we have found. Next is the standard rate. So D, we have discussed in the formula. What is the standard rate? Standard rate is nothing but the budgeted fixed overheads is already given. 2,700 is already given, and 180 budgeted hours is given. Hours multiplied by rate is fixed overheads, or we can say rate is equal to fixed overheads divided by hour. So 2,700 divided by 180 is going to be 15. Okay, the same 15 is the standard hour here also. So the standard hour is common. Standard rate is the rate which we have used for the budgeting purpose also. So for the budget or fixed overheads also standard rate is applicable, and standard fixed overheads also the standard rate is applicable. So the next only pending item is the standard fixed overheads, which we can easily find. 184 is there, 15 is there, 184 multiplied by 15. Standard hours multiplied by standard rate is the standard fixed overheads. We can calculate it as 2750. I have just applied this formula and found the variances. So it is as simple as that. Just plot the matrix. You are going to fill the data with that and plot the variances. So what is the check here? Okay, fixed overhead cost variance. Cost variance is equal to expenditure variance plus volume variance. So minus 100 plus 60 is going to be minus 40. So which means your fixed cost variance, fixed overheads cost variance is correct, fixed overhead expenditure variance is correct, and fixed overheads volume variance is correct. Now volume variance is categorized into efficiency variance, capacity variance, and calendar variance. In type 1 problems, where there is no detail about working days given in the question. So in the question there is no detail about working days. So we have to assume the actual working days and budgeted working days are same. Okay, carefully we have to note one thing is the working days are same between the actual and budget, but hours will be different. Okay, the work hours, they would have worked overtime or they would have worked different hours. Actual standard hours also they would have not worked, they would have remained idle. But whatever it is, the actual hours will be different. That's how the variance itself arises. Okay, but the working days no detail is given in the question, or it is same. Okay, so that's why calendar variance we have not calculated here. Here we have not calculated calendar variance because there is no calendar variance itself. Calendar variance is 0 in type 1 when actual working days and budgeted working days are equal, then there is no calendar variance. Okay, so you can apply this formula and you can see here calendar variance is 0 plus capacity variance plus efficiency variance is equal to volume variance, because volume variance is only classified into these variants. So volume variance is equal to capacity variance plus efficiency variance plus calendar variance. Here in type 1 calendar variance is equal to 0. So efficiency plus capacity 135 minus 75 is equal to 60. That is also tallying. All your variances are correct. Okay, so the problems are as simple as that. Students, the main advantage of standard costing is you can read the question very fastly and you can answer it very fastly. Your time will be saved. You will be locked somewhere else. Maybe in financial analysis you may require more time. So if you attend the standard costing problem, you will save time in your examination. So always give a shot. Okay, that's why I am putting this videos even before in the May month itself, so that you will have sufficient time for preparation. Okay, so yes, we will go to the next type of fixed overhead variance, and this I call it as type 2 variance, because here in the question actual working days will also be given, budgeted working days will also be given, and they both are not equal, they are different. And when they are different, calendar variance will arise, and calendar variance is not zero. In type 1, calendar variance is zero. This may be your objective type question also, so have in mind type 1. Okay, when actual working days and budgeted working days are same, calendar variance is equal to zero. Okay, if they are not same, then calendar variance is non-zero. Okay, how much we have to calculate in the question. Here also I am putting the almost similar matrix. Budgeted hours I have not changed, actual hours I have not changed, standard hours I have not changed, standard rate and standard rate here I have not changed. So budgeted fixed overheads, actual fixed overheads, standard fixed overhead, I have not changed anything, but I have added one thing, which is revised budgeted overheads. So why there is a revised budgeted overheads? For finding the calendar variance and capacity variance, we need revised budgeted overhead. In type 1 also we calculated the capacity variance. There the working days are same, which means revised budgeted hours is equal to budgeted hours. That's why we have that's why the calendar variance is zero. Here we are going to do the revised budgeted hours. So there is a little change in the formula for the capacity variance, and for calendar variance the new formula is also added here. Okay, so here I have given the formula. Cost variance, as usual, it is standard fixed overheads minus actual fixed overheads. Expenditure variance is very simple, budgeted fixed overheads minus actual fixed overheads. And volume variance is also very simple, which is standard fixed overheads minus budgeted fixed overheads, because the change in hours will be captured there. Next is the efficiency variance. There is no change in the efficiency variance. C minus B, which is standard hours minus actual hours, bracket multiplied by the standard rate. Next comes the capacity variance. So capacity variance is actual hours minus revised budgeted hours, bracket multiplied by the standard rate. So B minus I multiplied by standard rate. Next, the last one, the calendar variance is between the budget and the revised budget. Okay, so what is that? Revised budget hours minus budgeted hours, bracket multiplied by the standard rate, will give you the calendar variance. So here revised budgeted hours, how to calculate that also I have given here. So budgeted hours is for budgeted working days. Then for actual working days, what is the hours? That is called revised budgeted hours. So budgeted hours divided by budgeted working day multiplied by the actual working day. So budgeted hours is for budgeted working days. So for actual working day, for revised budget hours is for actual working day. So it is just a linear projection of the budget rate to the actual scenario, and we call it as revised budget hours. Okay, so this is what is the formula. We will see one example problem for this also. So illustration number 12. Okay, here number of working days is given. Yes, so number of working days is given. So this is type 2. Okay, so 20 and 22. If that is same, it is type 1. If it is different, 20 and 22, it is type 2. Okay, output per man hour is given. Overhead cost is given. So we can start filling our matrix. So budgeted overheads is given 1,60,000. So budgeted fixed overheads 1,60,000 I have taken here. Actual is 1,68,000. Actual is 1,68,000 I have taken it here. Next is standard rate. Yes, we can find the standard rate. So 1,60,000 is the fixed cost. Okay, divided by what is the hours? Hours is 8,000 is a man hour for one day, and there are 20 days. So 8,000 into 20 is 1,60,000. So 1,60,000 divided by 1,60,000 is going to be 1 rupee is the standard rate. So standard rate is common between these two. So we have filled this also. The next is the budgeted hours. So what is the budgeted hours? total hours as per the budget. Very simple, 8,000 man hours in one day, and there are 20 days. So 20 into 8,000, 1,60,000 is the budgeted hours. So what is the actual hours? Very simple, 22 into 8,400, 1,84,800. So most of the things we have filled up. The next most important thing is what is the standard hours? Okay, standard hours. That is what is very important. Here you can see, okay, 88,000 multiplied by 20 is 1,60,000 hours is required for 1,60,000 unit. So which means for 1 hour it is 1 unit. Okay. So actually how much units you have produced? So that much hour is the standard hour. Very simple. So actually how much unit you have produced? Overhead, okay, that we can find, okay, that we can find, okay, output per man hour is 0.9 is output for 1 man hour. There are how many man hour? 8,400 multiplied by 22. So 8,400 multiplied by 22 multiplied by 0.9 will give you the number of units that is produced, and that is 1,66,320. 1,66,320 units will be produced in 1,66,320 hours. So simple. So the standard hours for the actual production, that is called standard hours, that is 1,66,320. Okay, so very simple guys, 1,66,320, and standard rate is 1. So 1,66,320 into 1 is going to be 1,66,320. We have filled the table. I'm sorry, we have left out with one more thing, revised budget. What is revised budget? What is the budgeted hours? Budgeted hours is for budgeted working days. Then for actual working days, what is the revised budgeted hours? So simple, 1,60,000 is the budgeted hours. Okay, this is for 20 days. So divided by 20 multiplied by 22 will give you the revised budgeted hours, which is 1,76,000. The matrix is full. We have discussed about the formulas. Apply the formula, you can find the variance. Instead of putting the negative sign, you can put a in the bracket after the number. Instead of minus 1680, you can put 1680 bracket a. A means adverse variance. Adverse variance is not good for us. That's why the negative sign is coming. Not good means actual has gone higher than the expected. That is called adverse variance. That's why the negative sign is coming here. Okay, so you can apply the check also. Fixed overhead cost variance is equal to fixed overhead expenditure variance plus fixed overhead volume variance. So you can add these two, it will come 1680. Next, fixed overhead volume variance is equal to fixed overhead efficiency variance plus fixed overhead capacity variance and fixed overhead calendar variance. So you can add these three, it will tally with 6,320. And that's it guys, this is about the fixed overhead variance. So today we are going to discuss about the variable overhead variance also. Let's go to the next topic. So what is variable overhead? Variable overhead is variable in nature. Okay, these you can call it as indirect materials also. Okay, these are all variable overheads. Here also there will be rate at which the variable overheads will be recovered. Okay, recovered through the product cost or absorbed into the product cost. I'm sorry. So variable overhead variance is classified into efficiency variance and budget or expenditure variance. Expenditure variance is nothing but the standard minus actual. So that is very simple. Let's go into, so variable overheads is actually very simple. So you may get a problem in which you will be asked to calculate only overhead variance. At that time you should be careful enough to calculate both fixed overhead variance and actual variable overhead variance. Okay, so let's go inside a problem. So Vinayak Limited has furnished you the following information for the month of August 2012. Okay, so what is the output? Okay, that is given. Hours is given. This output is produced in this many hours, and fixed overheads is given. Okay, variable overheads is given, and working days is also given. Working days is different, so which means this is type 2 of fixed overhead variance, but we are not going to discuss about fixed overhead variance because both type 1 and type 2 we have discussed before. Okay, so calculate the variances. So for this kind of problem, you have to find all the fixed overhead variance and all the variable overhead variance. And this problem you are going to see especially for the variable overheads only. So what is variable overhead variance? So here you can see variable overhead cost variance is 3 minus 2. So what is 3 minus 2? This is 3 minus 2, which is budgeted variable overheads minus actual variable overheads is the variable overhead cost variance. Okay, what is variable overhead efficiency variance? It is 3 minus 1, which is budgeted variable overheads minus standard variable overheads. So efficiency is always, there should be a base. What is the base? Standard rate here is the base. So you can see standard rate is common, but standard hours minus actual hours. Okay, actual you have done the activity in so many hours, but as per the standard or as per the budgeting we have used this many as a standard hour. So for that plotting that, and that we call it as efficiency. That's why it is budgeted variable overheads minus standard variable overhead. What is standard? Standard is also similar to budget, but standard is plotted for the actual activities that has taken place. Actual scenario is taken into control to calculate the standard. Okay, so that's why we call it as efficiency variance. And next is the fixed overhead expenditure variance. Expenditure variance is nothing but 1 minus 2 standard variable overhead minus actual variable overhead. Here actual hours are common, so only based on the rate we are plotting the variance. That's why it is called as expenditure variance. And expenditure variance plus efficiency variance will be uh, cost variance. That is a checkpoint what we have here. Okay, so question is given. So from this question, what we want: standard rate we want, actual hours we want, actual rate we want, and standard hours we want. So we want the four data: standard rate, actual rate, standard hours, and actual hours. So actual hours, it is given in the question as 33,000. That is taken as it is. Very simple. Standard hours is very simple. You can see 30,000 hours is required for producing 30,000 units. Then for 32,500 units, what is the standard? It is 32,500 hours is the standard. So 32,500 is the standard. So here I have seen many people are taking 33,000 as the standard hour, or I have also seen some students taking 30,000 is the budget. So budget hours and standard hours are same. I will take 30,000 here. Your variance will not be right. That time also your check will work. Capital, I mean the cost variance is equal to efficiency plus expenditure variance. That will work. Okay, but your answer is totally wrong. Okay, so you have to apply the standard rate sitting inside the budget to the actual scenario to find the actual hour, I mean the standard hours. Okay, so 30,000 units from 30,000 hours, which means for 1 unit 1 hour is the standard. So which means 32,500 unit, actual is 33,000 hours, but standard is 32,500 hours. So 32,500 hours we have taken. Actual hours is taken, standard hours is taken. Standard rate, what is the standard rate? Here variable overheads is 60,000, that is for 30,000 hours. So 60,000 divided by 30,000 per hour, 2 rupees per hour. Actual rate is 68,000 divided by 33,000, which is 2.06. So very simple. Okay, so we have found all this. If we can apply SR into AH, which is 2 into 33,000, which is 66,000. Standard variable overheads. Actual variable overhead is the actual rate multiplied by actual hour. What is budgeted variable overhead? For budgeted variable overhead, standard rate is common, multiplied by the standard hours is the budgeted variable overhead. Okay, so we can calculate the variances and do the check. Minus 3,000 is equal to minus 1,000 plus minus 2,000. So you have done the check. So the variable overhead problem is very simple. We just have an expenditure variance, which is going to be the budget minus actual. I'm sorry, it is going to be the standard minus actual. Okay, and there will be an efficiency variance, which will be the budget minus standard. Okay, and sum total of these two is going to be the variable overhead cost variance. So students, very soon I will be out with my next class on the sales variance and profit variance. So thanks a lot and all the very best, students.